5 tips to reduce your taxes in Canada in 2024, coming from a qualified accountant and CFO. Some quick facts. University of Toronto research have shown that 10 to 12% of Canadians do not file their tax returns. As a result, they lose out on various benefits since tax return is used to test eligibility for various benefits. Such benefits are Canada Workers Benefit, Canada Child Benefit, GST/HST credit, etc. Also, 5% Canadians file their tax returns late. So what are the deadlines for tax filing? If you are an individual, due date of filing your tax return is April 30th. If you or your spouse is carrying on business, or if you are self-employed, due date is June 15th. However, for 2024, it is June 17th considering the weekend. For a corporation, due date is 6 months from the end of their fiscal year end. A company can choose its fiscal year, so it can be 31st January for some companies and 31st July for some others. There are penalties for missing such deadlines, which are linked to how much tax you owe to the government, how many months your return is outstanding, if it's your first default or not. So it's important not to miss such deadline. Welcome to Money and Mind, your go-to channel for unraveling the mysteries of personal finance. I am Abhijit, your guide to navigate the world of money with ease and confidence. Let us dive straight how we can legally save taxes by being aware and take full advantage of the various provisions of Income Tax Act. I will be mostly focusing on the general deductions that are applicable to everyone, with special focus to salaried employees. So in other words, these are the expenses that we incur in our day-to-day lives, and we do not expect anyone to spend something extra to qualify for such deduction. Number 1, RRSP. RRSP stands for Registered Retirement Savings Plan. As I mentioned in my earlier video, RRSP is a great tool to not only save taxes but also a great investment vehicle. It has 3 inbuilt features in it. Number 1, it brings in great discipline to invest. You are able to enjoy low asset management fees due to economies of scale. And third, dollar cost averaging principle, generate great returns in medium to long run. You are eligible for deductions for contributions made to your as well as your spouse's RRSP. This can be a good retirement strategy based on the principle of income splitting to keep the effective tax rate low for the family. The deduction is limited to the unused RRSP contribution room from the prior year, to which lesser of the two gets added: A, 18% of earned income, B, $30,780, which is the limit for 2023. In other words, if you are someone who always likes to utilize your RRSP contribution room, which ideally everyone should strive for, you would not have any unused contribution room to start with, and your RRSP contribution for this year is typically limited to 18% of your earned income. As long as you are earning a net income of less than $171,000, for high income earners more than $171,000, it gets capped at $30,780, which is the limit for 2023. Another point to note is such limit stands revised every year to keep pace with the inflation. As regards timing, one can contribute up to February of the following calendar year to qualify as RRSP for this year. For example, for 2023, you could contribute up to 29th February 2024. Second one, home office expenses. Working from home has become a new norm since pandemic. A lot of companies are still allowing their employees either to fully work from home under a remote model or work hybrid model. So this deduction is for all those employees who are mostly working from home. Until 2022, there was a temporary flat rate method of deduction which was $2 per day, subject to a max of $500 for the year. However, since 2023, this temporary flat rate method has been done away with, and now an employee needs to apply under a detailed method. Let us understand the eligibility for this. One needs to work from home at least 50% of the time for at least 4 consecutive weeks in order to be eligible for this. This needs to be based on a verbal or written agreement with your employer. Let's understand with help of 2 examples. Suppose employee A, who is working from home at least 3 days out of his 5 working days for at least 4 consecutive weeks during a year, then he will be able to meet the threshold of 50% and will be able to claim expenses under this head. Whereas, say employee B, who is working for 2 days out of his 5 working days, doesn't meet the threshold of 50% and thereby cannot apply for any deduction under this head. Expenses you may deduct are proportionate share of cost of electricity, heating, water, cleaning, maintenance, internet access fee, as well as proportionate rent if you are renting your home. One needs to determine the area of the workspace and the total area of the home, including all finished areas, and determine the percentage of your home that your office space occupies. For example, if your total home is 1000 square feet and your workspace is 100 square feet, then you can apply that 10% to all of these expenses to come to the eligible expenses that you can claim under this head. As a homeowner, you can't deduct notional rent, mortgage interest, property tax unless you are a commission employee. Certification. Your employer must certify Form T2200, which is Declaration of Conditions of Employment, which states that you are spending these expenses and your company is not reimbursing any of that. Number 3, medical expenses. Again, we under this head, which are not covered by OHIP for Ontario or other provincial bodies of Canada. It can be medical expenses, prescription drugs, dispensation fees, dental expenses, or any travel expenses incurred in connection to that. You may incur expenses even outside Canada that will be eligible under this head. Eligibility. Any expenses incurred on yourself, your spouse/common law partner, children, including adults, children who are dependent on you, dependent parents or dependent relatives will qualify under this head. The amount to claim. Eligible expenses under this head, lesser of the two. A, 2,635. B, 3% of your dependent's net income. Sorry, what does this mean? Let's try to understand this in simple plain English. If your income is more than $80,000, then you need to incur at least $2,635 under eligible expenses under this head to be able to claim any deduction. If your income is lower than that, then your threshold stands reduced and you can still be able to get deduction if you are spending. For example, if your net income is $50,000, then this deduction threshold is $1,500, which is 3% of $50,000, and any expenses over $1,500 will be eligible to be claimed as a deduction. If both the spouses are working, then it makes sense for the low income spouse to claim the medical expenses for the entire family under this head, as the income threshold stands reduced and you can claim more deduction under this head. If you are getting value out of this topic, can I ask you to smash a like and please subscribe to my channel for such interesting topics. Number 4, charitable donations. Again, a lot of us like to be associated with a charity and have our favorite charities where we regularly contribute to. It can be our church or temple where we often visit. Eligibility. Official donation receipts from organizations that are eligible to issue is needed. Please check that such receipt contains the address, their unique serial number and charitable registration number, which is equivalent to the business number as required for corporations. This is required as a proof that they are eligible institutions who can issue such receipt. The amount to claim. The tax credit depends on amount you paid, your net income, and it normally has two components, provincial and federal. So it depends on the province you live in. As a thumb rule, if you're contributing $400 per year in Ontario, you can get a tax credit of $80, including both federal and provincial portions, which is about 40%, which is not bad. Number 5, automobile allowance slash expense. Again, this is a common expense that most of us have. If it's an allowance, it's generally taxable if it's not linked to distance. However, it can be deductible and employees can claim the expenses such as capital cost allowance, lease cost, cost of upkeep, maintenance if the following 4 conditions are fulfilled. Number 1, the employee was required to pay for such expenses as per the contract. Distance travel to and fro, home to work would not qualify as an eligible expense. Number 2, the employer didn't reimburse any of those expenses back to the employee. Number 3, the employer has to sign Form T2200, which is Declaration of Conditions of Employment. This is the same form as required under Home Office expenses. Number 4, the employee keeps records to support the claim, including a logbook which contains destination-wise distance traveled for work. Please like, comment, and subscribe to my channel below if you would like to continue with your journey towards your financial freedom. Thank you.